Barter system. Before money existed, survival depended on one thing: finding someone who wanted exactly what you had, at exactly the moment you needed what they had. A farmer with grain needed a blacksmith who needed grain. If the blacksmith didn't need grain that day, you went without tools. The whole system was one giant coincidence machine. And for a while, it worked, until communities grew too large for coincidences to keep up. Something had to replace it. What people found next lasted thousands of years. Cowrie shells. It wasn't gold, it wasn't silver. The first widely used currency was a shell you could find on a beach. Cowrie shells traveled across Africa, Asia, and the Pacific for centuries, showing up in tax payments, marriage dowries, and major trade routes. They were small, durable, and nearly impossible to fake. For a long time, they were perfect. Then one day, traders discovered they could collect them in massive quantities. When supply explodes, value collapses. The cowrie was finished. So people went looking for something harder to replicate. Metal ingots. They turned to metal: copper, silver, gold, shaped into bars and valued by weight. Every transaction meant pulling out a scale, sometimes a chisel, to cut off exactly the right amount. It was slow and awkward, but it introduced an idea that changed everything. Metal could store wealth. You could earn it today and spend it a year from now. Value could travel through time. That idea was powerful, but carrying around lumps of metal and a scale wasn't exactly convenient. Someone was about to solve that problem, and it would change trade forever. Ancient coins. Around the 7th century BCE, in a kingdom called Lydia in what is now Turkey, someone had a simple but world-altering idea. Stamp the metal. Put a mark on it. Let the government guarantee its weight so no one has to carry a scale. The first true coin was born, and within decades, the idea had spread to Greece, Rome, India, and China. Commerce became faster, taxation became easier, strangers could trust each other across long distances. But even coins had a weakness, and one empire would discover it the hard way. The Roman denarius. The denarius was the dollar of the ancient world. It paid armies, bought grain, and held together an empire of millions. For centuries it worked. Then the empire started running out of money, and instead of admitting it, emperors did something quiet and dangerous. They reduced the silver content, just a little at first, then more, then more. Citizens noticed the coins felt different, spent differently, bought less. Trust eroded slowly, then all at once. The denarius collapsed, but the damage it left behind taught future economies a lesson they wouldn't forget. Meanwhile, on the other side of the world, someone was about to reinvent money entirely. Chinese paper money. China looked at the problem of heavy coins and asked a question no one else had dared to ask. What if the money didn't have to be made of anything valuable at all? Merchants had already started using paper receipts to avoid hauling coins across long distances. The Tang and Song dynasties formalized it, issuing the world's first government-backed paper currency. It was lighter, safer, easier, and it proved something radical. Money is not a thing, it's an agreement. That idea would take centuries to reach the rest of the world. In the meantime, medieval England had its own strange solution. Tally sticks. A wooden stick notched with a number, then split in half. One piece for the debtor, one piece for the creditor. When the debt was settled, the two halves had to fit together perfectly, a built-in forgery system that was nearly impossible to beat. It sounds primitive, but tally sticks ran the English royal tax system for centuries, simple tools solving complex problems. But simplicity has limits. As economies grew bigger and more connected, something more powerful was needed. The gold standard. By the 19th century, most major nations had a new solution: tie every banknote to a fixed amount of gold. Your paper money wasn't just paper, it was a claim on real gold sitting in a vault. It kept inflation low, exchange rates stable, and public trust high. For decades, it worked beautifully. Then came world wars, economic collapses, moments when governments needed flexibility the gold standard simply wouldn't allow. One by one, nations walked away from gold. What replaced it was something that would have seemed insane to an economist a century ago: fiat money. Today's money is backed by nothing. No gold, no silver, no commodity of any kind. It has value because the government says it does, and because enough people agree. That might sound like a house of cards. In some ways, it is. But fiat currency gives economies a flexibility that no previous system could offer. Central banks can expand or shrink the money supply in response to crises, recessions, wars. The whole system runs on collective belief. And now that belief is moving somewhere new: digital currency. Most money today doesn't physically exist. It's numbers in a database moving invisibly between accounts at the speed of a tap on a screen. Cryptocurrencies have pushed that further, proposing money that exists entirely outside of government or institutional control. Whether that works long-term remains an open question, but the direction is clear. Money is becoming pure information.